If you have a Roth IRA and have always wondered what the heck should I put that money into, then this video is for you. In this video, I'm giving you 5 ETFs that you can invest in when it comes to your Roth IRA. The first 3 ETFs are designed for capital appreciation, meaning your portfolio will grow exponentially over the long term, so you have enough to live on when you get to retirement age. The remaining 2 are focused on dividend income, meaning it's gonna give you a lot more money back in dividends, which really is more focused on income stream and higher levels of income stream. So let's dive right into it. Let's go. Just as a quick refresher, what is a Roth IRA? A Roth IRA is an individual retirement account that's available for many of us to invest into for retirement, right? And so not everybody might be provided a 401k from their, say, 9-to-5 job, but everybody can take advantage of a Roth IRA. You might be an entrepreneur, you might be in freelancing, contract mode, so you don't have certain benefits. And even if you do have access to 401k, yes, you can also have a Roth IRA. These investment retirement accounts gives us great opportunity and huge advantages. So let's cover 3 of them quickly. First is tax-free growth. The Roth IRA stands alone and unparalleled when it comes to the tax advantages that we have as investors. What this means is, as you're contributing money to your Roth IRA over the long term, the decades, guess what? The money's already taxed up front, and so all your gains and profits that you make in your Roth IRA portfolio, you never ever have to pay taxes on that when you begin withdrawing the money and living on it in retirement, right? So because you already take care of the tax up front, it grows and you don't have to pay no taxes ever. Now that is a life hack, because you and I both don't know what the tax bracket would look like 10, 20, 30 years from now, right? So imagine that you don't have to pay taxes on your money in the future. Think about it that way, right? Paying taxes now is painful. They're killing us. So it would be nice to get all the profit and not have to pay taxes. Unlike traditional IRAs or 401ks, those you have to pay taxes during retirement, right? Because the money is invested tax deferred, meaning you haven't paid taxes on it. And so when you begin to withdraw that money into retirement for 401ks and traditional IRAs, you end up being responsible for having to pay those taxes back. And that is the biggest advantage that Roth IRA has over, say, traditional IRAs and 401ks, right? We don't want to pay taxes in the future. Second benefit of a Roth IRA is the flexible withdrawals, meaning you don't actually have to wait all the way till retirement age to be able to touch the money. Now, with a Roth IRA, you can touch the money that you contribute to the account after 5 years. You just can't touch the gains until retirement, right? And so let's say over the course of 5 years, you've managed to contribute $50,000 because you've been very diligent and very strategic and lived on less than you make. So you contributed $50,000 to your Roth IRA, and over that 5 years or 10 years, whatever the time frame is, the portfolio has grown to, say, $100,000, right? You have the flexibility and to go and touch your $50,000 that you put in. You can withdraw that, no penalties, no taxes got to be paid on that, right? And the gains will just keep growing, and you can't touch the gains. That is huge, because unlike traditional and 401ks, if you touch the money, any part of the money, whether it's your contribution or the profits, you are going to have to pay a 10% penalty fee, and you're going to pay tax at your income tax, at your ordinary income tax bracket. Okay, so that is huge when it comes to Roth IRAs, because you have flexibility to touch your contributions after 5 years without any fees or penalties. And that flexibility is very attractive. Another huge benefit for Roth IRA is that there are no required minimum distributions, meaning you don't have to take a certain amount of money from that Roth IRA when you're in retirement age. With traditional IRAs and 401ks, there are minimum requirements that you have to take out, right? So let's say the minimum requirement for 401k is, say, $50,000. That means every single year you have to withdraw at least $50,000. When it comes to Roth IRA, you don't have those stipulations in place. And so it actually allows you to not only build great wealth for yourself, but you can pass down to the next generation a huge portfolio that is tax-free, that they don't have to pay taxes on it, any fees on it, and that can continue growing for, say, your children and your children's children over time, right? That is huge. Next advantage to Roth IRA is really the ability to mitigate your risk through diversification. And in my opinion, especially if you're somebody who have at least 20 to 30 years until retirement age, the only types of investments that you should probably have in your Roth IRA are index funds or ETFs. And so in this video, I'll interchange index funds and ETFs because they're virtually identical. They're like twins, the same thing, no difference. And the reason why I recommend that when it comes to Roth IRAs, you invest in ETFs. And the primary reason why you don't want to have individual stocks in your Roth IRA is because this is retirement money, okay? This is not play around money and see if it flips 1,000 into 100,000. No, you don't want to gamble with your retirement, okay? So you want to diversify through index funds / ETFs because that allows you to reduce your risk and downside of losing the money and maximize your upside and the gains over time. And so that diversification gives you exposure to all the different sectors, all the different industries that we all operating. So you name it. There's about 11 different industries, sectors that really make up the economy. And so you have exposure to all the important businesses in all these different industries. Work smarter, not harder. These ETFs have the lowest cost associated with them, and that makes investing really easy, simplified, passive, and guess what? You keep more of the money that your portfolio actually makes. Many people don't think fees make a huge difference. Whenever you hear expense ratios, think fees. Expense ratio is just a fancy word for fees. That's all it is, okay? But people don't think 1 to 2% in fees or expense ratio is nothing. They think it's not much, but you have no idea because that will cost you over $200,000 in your investment journey. And that is a huge chunk of money that you could have for yourself and your family. So take advantage of these ETFs and index funds that I'm recommending because it costs you the least amount to keep them and benefit from all of it. Lastly, the consistent growth when it comes to ETFs is unmatched, okay? We can look through history, 100 years of data. You can Google it, you can YouTube it. It is virtually impossible to beat these ETFs. Even though investing in individual stocks can be tempting, exciting, based on what you see on social media, and you might even have a few individual stocks in your portfolio that is doing incredible things, right? But that is extremely risky. So I never recommend when it comes to retirement accounts, nobody should really have individual stocks in them because there are a lot of factors associated with that and some dangers there. So let's dive into just a few of them. And the first one is that individual stocks are extremely high risk and volatile, right? They are way more volatile than your index funds and ETF options that are available to you. And part of the reason why they're so volatile is because it is extremely difficult to predict and people are trading them back and forth and anything can happen. So we have to be very cautious. And part of doing well in the stock market is not about excitement and picking individual stocks. That is a poor strategy because in 20, 30 years from now, you and I both don't know what companies are going to be around and which ones are actually going to be killing it in the game, right? And so how do we even go about picking individual stocks for retirement? That is a poor strategy because none of us can see that far. Not even the professionals on Wall Street can. So definitely stay away from individual stocks when it comes to your Roth IRA, your 401k, and retirement accounts. For taxable brokerage accounts, I'll make videos later to help educate and teach you guys how to actually analyze, do research, and how to pick individual stocks. But as of now, we're working backwards, right? Retirement first, and then early retirement. Let's not forget the lack of diversification when you pick individual stocks is very much rare, right? If you just buy a few stocks in, say, the technology sector alone, you are 100% dependent on what happens in tech, what happens to those individual companies. You don't want that type of risk, okay? Because these companies can go out of business. They're not perfect. Nobody is. Anything can happen. Competition can come into play. And so you don't want to be exposed to just one little area of the global economy. You want that diversification and you want to be exposed to all of it. Why? Because you can have all of it. There's no reason to pick just one thing or just a few things. You can own all of it and spread out the risk. That's what ETFs give you. Like I said, I'll show you guys exactly how to do the research and you're gonna learn and realize that part of the disadvantage in putting individual stock in your Roth IRA or retirement account is the monitoring and maintenance, okay? When you buy an individual stock, you actually have to follow the stock, you have to follow the company, you have to follow their earnings, you have to read the annual reports, you have to read the 10Ks, the 10Qs, you have to literally know what's happening with the business almost all the time because at any moment, something can happen to the business that will impact your portfolio, right? Because you own it. And so that maintenance, that level of awareness, constantly being plugged into everything happening, that's not something that most people actually want to do, number one. And secondly, many people actually do it not in a beneficial way or an effective way to actually enhance their portfolio, right? So the point of investing is so your money can go to work so you don't have to. But if you have to always babysit and keep an eye on it every time, are you really living, right? Like, are you really enjoying life? Are you focused on the things that matter most in terms of your physical health, mental health, relationships, right? Family dynamics, experience in the world? Absolutely not, right? And so we need to learn to continue separating ourselves from the money and not put ourselves in trouble. And the best way to do that, again, is what? ETFs, you guessed it. Plus, there are just too many stocks out there. It's insane. There's over 12,000 stocks traded on the New York Stock Exchange alone, and that's just one out of many all over the world. How do you know which ones are actually worth having? It's just too much headache, right? And so you do not want to be exposed into that black hole because it gets crazy and it gets serious. I don't recommend it, not for your retirement accounts, okay? While there can be success stories when it comes to individual stocks and very high profitability and achievements there, we have to be very careful because when it comes to retirement, the goal is not to focus on doubling your money overnight. It's about consistency, stability, security, and getting to that retirement age and having enough resources guaranteed for sure, right? When you buy individual stocks, you're taking on an extremely high risk investment, and many of us may not actually really understand what we're actually doing. And so the easiest way to do it is to buy ETFs. So now let's talk more about exactly the 5 ETFs that I'm going to be recommending now that we've done a really good recap on Roth IRA, the pros, the cons, some of the things to look out for, and being cautious about picking any individual stocks for the retirement account. The first ETF that we're going to cover is the Vanguard S&P 500 ETF, ticker symbol VOO, and this is the flagship. This is the vanguard of the economy. It's the most important and well-known ETF across the globe simply because it is a benchmark, a determinant of exactly how well or how bad the economy is, both in the US and also globally. And let's dive a little bit deeper into what VOO is and why it's so important to the investment world. For starters, it's a low-cost ETF, and that's one of the primary virtues of any ETF that you're going to find that we'll discuss. The fees, remember I mentioned earlier, the fees are important. So when it comes to VOO, the fees is 0.03, not even 1% in fees, not even 10% of 1% is 0.03, meaning you're actually paying damn near nothing. So for a quick analogy and example, if you had let's say you invest $10,000 in VOO over 10 years, right? Over that 10 years, the actual fees that you will end up paying for holding this ETF or fund is really around $230 over the course of 10 years, okay? Now, for a lot of funds that are similar but has a lot of mutual funds or these other funds out there, they have between 1 to 2% in fees, or maybe 1% in fund fee, but then you have management fees, right? If somebody's managing it for you, they're also charging you fees. In that scenario, you end up paying $2,000 out of your $10,000 you initially invested over the 10 years just in fees, right? That's 20% in fees. Even though it's disguised that's 2%, in reality, it pays out as 20%. So you don't want to forfeit or lose 20% of your initial money that you contributed, which is $10,000, right? You want basically all that money back to you. And you're going to get that through this ETF that I've just recommended, because you're only paying $230 something at most, and you keep all the gains. Next great thing about this ETF is it is a broad market index / broad market ETF. And what that means is you have exposure to all the different 11 industries and sectors that I mentioned about earlier, right? This is about diversification. So when this S&P 500 index or ETF, you have ownership and exposure to roughly 500 companies across the board, right? That is insane. So you don't have to worry about which individual company is going to do well, which one. You have exposure, you have all 500 in your back pocket. So what this allows you to benefit from is all the advancement and advantages that these companies have, right? So as these companies make money, you make money as a result. So they all work for you. They don't know it, but that's the beautiful thing about investing. It's about money at work and not you at work. And this gives you a strong foundation for retirement and building upon your portfolio. And even though it's diversified across all 11 sectors and industries, There are 4 that have the highest exposure because those 4 are actually designed literally based on life. Remember, like I always say, I teach you guys how to invest based on life and not money. And if you invest based on life, you will always have the money. It's just as simple as that, right? And so the portfolio is broken down into all the sectors, but 4 of these sectors hold the biggest percentage in the entire portfolio. So let's talk about them quickly and then move on to the top 10 individual stocks that's in these portfolios. And you're gonna understand why there might not be a need for you to actually be buying individual stocks yourself. Coming in at number 1 is technology, as you guessed, and that holds 29% of the entire portfolio. Next is healthcare with about 13%. And coming in third is financial services, which is around 12%, 12 and change. And then lastly, we have consumer cyclicals, and that holds around 10.7%. So basically we can round up to 11%. And these 4 sectors make up the bulk of this fund. And the rest is split among the other industries that are available, such as energy, industrials, consumer services, right? Real estate even included within this S&P 500 index fund / ETF, ticker symbol VOO. So this fund has 500 companies put together in one basket. And so we're gonna talk about the top 10 holdings briefly. But before we do that, you would notice that I seem to cover 9 out of the top 10 because Alphabet, aka Google, actually have 2 different classes of stocks, right? They have a class A stock and a class B stock. And what that really, I'm not gonna dive too much into that. That would be for another video. But essentially they have 2 stock offerings that's available. Granted, they're basically the same, very much so. There's a few changes about what a stock A can do and the capabilities of that, or whoever owns the stock A has certain rights, such as voting rights, whereas somebody who has, say, a stock B or stock C may not have the same rights, but you benefit the same monetarily in a certain way. And so you'll notice that I'll cover about 9 as opposed to 10 individual companies. With the top 10 holdings, Microsoft and Apple hold about 12% each, right? And that is a huge exposure of the entire portfolio to these 2 companies. Why? The reason why is because these 2 companies are essentially the best companies on the planet, right? Apple was the number 1 and just recently got overtaken by Microsoft. I'm pretty sure there's going to be a good battle of some back and forths going there. But these are companies that is great to have in your portfolio. And in this case, for retirement, it's in the ETF. Instead of you buying it individually and having 100% high risk to these individuals, you have them as well in this fund with a fraction of that risk level, right? So that's the first 2 that hold the biggest weight out of the top 10 in this ETF. Next is Google, aka Alphabet, which holds 4%, and this is massive. And that is followed by Amazon, which holds roughly 3.5% in the portfolio. And then we have Nvidia, right? The new supercharged Trojan horse that is just coming in hot and blazing and passing everybody in its tracks all the way to the top is Nvidia. And that holds 3% within this portfolio. Well, this ETF. We have Meta Platforms, formerly known as Facebook, with 2%, followed by Berkshire Hathaway, that comes in at 1.7% of this portfolio. And if you don't know, Berkshire Hathaway is owned by Warren Buffett, arguably the most important, influential, and best investor of all time. Tesla comes in at 1.5%, and lastly, United Healthcare comes in at 1.4%. And so when you add this top 10 holdings all combined together, they make up roughly 32% of this Vanguard S&P 500 ETF, ticker symbol VOO. This is amazing because having exposure to these powerful individual companies means you're going to do well for the long term. Not only that, there are other 490 plus stocks, individual stocks, that's part of this entire pool, right, entire bucket. And the beautiful thing about it is, over time, the individual stocks that are in this bucket that are not performing well to the standards of the bucket, they get removed and then they get replaced by better ones, right? And so you can understand why this fund is so powerful and why it's virtually impossible to beat it over the long term. It only goes up. And the gains is extremely powerful because in 2023, this ETF returned 24% to investors, which is wild because even high yield money market accounts was returning about 3 to 5%. Even short-term bonds was given about 3 to 5%. But guess what? This portfolio provided investors with 24%. And so it is virtually impossible over the long term to beat what the market and the stock market is going to produce for investors. Because when you factor in inflation, right, you subtract inflation from the gains, you would notice that even high yield savings, when you factor inflation in, you're only getting about 1 to 2%. Same thing with some of these bonds and some of these other fixed incomes. But when you do the same thing with, say, the stock market over the course of 2023 or its history, you will notice that even factored in for inflation, it has the highest return for investors. The point of investing is to make money, okay? And I want you to make money without you having to work. That's what this is all about. Over the last 5 years, it has increased by 75%. Over the last 10 years, it has increased by 163%. And over the last 20 years, it has gone up 305%, okay? So think about it. The longer you invest, the more money you're going to have. And this is retirement money. You don't want to gamble it away on individual stocks. The beautiful thing is these funds and ETFs are highly accessible. They're available to virtually everybody that has investment portfolios. So whether you're going through brokerages such as Fidelity, Charles Schwab, Vanguard itself, Robinhood, M1 Finance, Webull, you name it, you can literally search within the brokerage VOO and it will show up, and everybody basically have access to being able to invest in it at a fraction of the cost. That's something that's really special because many of us actually don't know that when it comes to certain types of investment accounts and vehicles, some of them have limited options of funds and ETFs to pick from. So for example, from your 401k, if you go and look at the options that you have to invest into, you will notice that there are limits. That they're not like unlimited, there's not everything out there. And so some of them have, this VOO or in another variation of it, but very similar, or some of them don't have it at all. But the beautiful thing is with VOO, a lot of these, brokerages, 401ks, Roth IRA accounts, traditional IRA accounts, taxable brokerage accounts, for the majority of them, you can get access and they give you options to actually buy this. And that is something that's huge, and I want everybody to take full advantage of that. The second ETF I'm recommending for you to look at and potentially add to your Roth IRA is Vanguard Growth ETF, ticker symbol VUG. This is how you're going to supercharge your capital appreciation because it's a little bit more aggressive, but still conservative and protects you on the downside, but you're gonna gain more. And check this out, it actually provides more returns than VOO. VUG is really a standalone, one of a kind that allows and gives investors the ability to supercharge and take advantage of growth opportunities without taking on too much risk. VUG is built and designed to really track the US largest capitalization stocks. And in order for a company to be considered large cap, right, that means that this company has to be worth at least $20 billion. Now you're gonna realize something, that in this case, by largest cap, they're actually tracking the biggest of the biggest in the game, right? And so you're talking about the companies that are worth hundreds and hundreds of billions of dollars, and a few of them are actually worth trillions of dollars. The ETF has a huge emphasis on innovation and future growth. And so the characteristics and how they go about tracking these individual stocks or adding these individual stocks to the ETF is based on their actual performance, the growth potential, actual tangible growth, right, and the profitability of these companies. And so when I read off the top 10 companies within this portfolio, this fund ETF, you will understand why it is actually it grows a lot more than say VOO and some of the other funds and ETFs that I recommend. The strategic positioning is that it's actually seeking the companies that are at the forefront of innovation, right? And when you think about it, there is no better time than the world that we're living in now to lean heavy into this type of ETF. Why? We have AI in the game, heavy, machine learning, right? Automation, algorithms, computing power, processing power. We have all these other things that are going to make businesses more effective, productive, provide us, you and I, with more value, improve our standard of living, improve everything that we use and consume. I mean, it's embedded in the fabric of our day-to-day lives, right? And it's only gonna get better. And when it comes to AI, we are just at the beginning. We are just scratching the surface, right? Think about what the internet was when it first came out, right? That was the surface. Look at all the things that we've been able to do as a result of the advent and the invention of the internet. Think about this in the same way, but 10 times bigger than the internet, right? And so this is the perfect time to benefit from it because 10, 20 years, 30 years later, you're gonna reap all the rewards from all the companies that are making the profits, and the ones that are worth having are literally put into this VUG. Now, while past performance doesn't mean future results, it is a very compelling argument because the only thing we can go off of is current performance and past performance, right? And so based on this track record, it is very compelling, and you're going to see why it is definitely worth considering it, at least in your portfolios, your Roth IRAs, and other investment vehicles that you have. So if you recall, I mentioned that VOO returned 24% to investors in the year of 2023. VUG in the same year returned 42% to investors, right? That's basically doubling that. That eclipses what VOO did in 1 year by twice. That is how powerful and forward thinking this fund is. Over the last 5 years, this fund has grown by 114%, 208% for the last 10 years, and this is insane. For the last 20 years, it has grown 508%. You have to understand how powerful that is, right? Imagine your money growing at this rate for a long term. You are going to do incredible things. That means if you had invested $1,000, that $1,000 from 20 years ago is what? $5,000 today. Now, that is just a $1,000 one-time investment 20 years ago. And it grew 5 times, right? So think about being able to contribute more consistently. Maxing out your Roth IRA, which is $7,000 for everybody that's below the age of 50, and everybody else that's above the age of or at 50 or above. To catch up, you can contribute up to $8,000 a year. So do your best to really max out these Roth IRAs, because the future you is going to thank you. The present is going to thank the person that you are today if you begin making these decisions and investing consistently. If you don't, the future you is going to hate the past you, and is also going to hate the present you at the time. You get it. And so when it comes to the breakdown of the sectors, 45% of this index fund / ETF is exposed to the technology sector. Now that I said that, you're like, well, yeah, now it makes sense why it is so profitable and grows quickly. And that is because everybody's tech dependent. The entire country is tech dependent. That's not stopping no time soon. The entire world is tech dependent. If anything, tech is going to take more precedence and get even a stronger footprint in our lives, in business lives, in everything that we do, right? So picture what this is going to look like 10 years from now. 45% of this ETF is technology sector. That's massive. At this point, we're all familiar with why technology is so big in here and why it's so important, right? Because it is the driving force and the engine behind all and every economy. Without that, we're in trouble. Imagine without technology, I can't even make this video that can help other people. I'll be stuck. 16.6% of the exposure in VUG comes from consumer cyclical stocks, and then followed by the third spot, which is communication services, coming in at 13.5%. The craziest thing is the top 10 individual stocks in this ETF that I'm going to read out now makes up 55% of this entire ETF. That is how powerful these individual stocks are. And like I said, you don't have to expose yourself to buying the individual stocks themselves. You already have them here, and 98% of the work is already done for you. You don't have to pay attention to it. You don't have to follow it. You don't have to do all these research and stay plugged in and take the highest risk. It's not worth it in the long run when it comes to retirement accounts, okay? So in here, you just buy and just buy and buy and buy and go on and live your life. That's it. When it comes to the top 10 holdings, the 2 companies that hold the biggest percentage and weight within this entire VUG ETF is Microsoft and Apple. Again, Microsoft holds 13% in this one, and Apple also holds 13%. So you will start to see a common theme of why some of these companies are heavier and why others are not, right? Because generally, the heavier these companies are, the more potent they are, right? The more growth potential they give us. And so these funds are great at selecting individual companies that are top of the top, right? This is your 5 stars. This is your holy grail, right? This is your Michael Jordans. This is your Kobe Bryants. This is your LeBron James. This is your Messi, Ronaldo. This is your Mahomes, right? Getting all these championships. This is your Tom Brady. Let's not forget, probably the best quarterback of all time, okay? So that is really a common theme that I want you to pay attention to. And that's why there's no need to take on certain risks. If you have these already, what's the point of putting yourself at a potential, loss for the long term. Google, aka Alphabet, comes in at 7%. Amazon comes in at 6% in change, and then we have Nvidia coming in at 5%. Meta and Tesla both have 3%, right? So Meta's 3%, Tesla's 3%. And then we have Eli Lilly, which has had a monster year, especially in 2023, and should probably have a pretty monster next decade coming up. They come in at 2.5%. And then lastly, we have Visa. Yes, the credit card issuer company, Visa, is 2% when it comes to this top 10. Again, this top 10 here makes up 55% of this ETF, ticker symbol VUG. The third ETF for your Roth IRA, which is the final of our capital appreciation ETFs, is the Invesco QQQ ETF, okay? Ticker symbol QQQ. Here we have another ETF that is synonymous with innovation and growth. And so for any investor that wants to get that extra exposure to growth, especially in the technology sector, this is a great recommendation that you can definitely do some additional research on and potentially add to your Roth IRA. Let's look at some of the reasons why QQQ is an exceptional ETF and a great option for investors. This ETF tracks the NASDAQ 100 index. And this NASDAQ 100 index is composed of 100 of the largest companies, with the exception of the financial sector, that trades on the NASDAQ stock exchange, right? So picture 100 individual companies put together in one, and these are the largest that trades on the NASDAQ. And so by investing in QQQ alone, you get exposure to all these 100 companies that are trailblazers, that are synonymous with innovation, advancement, and technology. And these companies that are in there are some of the most innovative and disruptive companies, right? So a lot of them are technology companies, healthcare companies as well. You have a lot of artificial intelligence related companies in there. And also, let's not forget biotechnology. That's a massive one. Historical performance of this ETF is insane because it shows a lot of resiliency and its ability to navigate market conditions, volatility, and a lot of the stressors, right? It is pressure tested, and it always finds a way to pierce through to the top. And you might think VOO and VUG are both extremely powerful, which is true, but I can promise you there are levels to this game. And QQQ is in its own bracket, a league of its own. Is really the Michael Jordan, the Tom Brady, right? And the reason why I say that is because in the year 2023, it returned 47% to investors. When you zoom out and look at it in the long term in terms of decades, when over the last 5 years, it has returned 140% to investors. Over the last 10 years, it has returned 350% to investors. And over the last 20 years, guess what? 975% growth. That is insane. It's basically on track to do numbers that has basically been unheard of for ETFs and funds. So this is something that, take a little note, put a little star next to it, you definitely want to think about putting it in your portfolio after you've done some more additional homework along with this video. 50% of it is in technology stocks. That's a no-brainer. That's part of the reason why it grows so exponentially. And then 15% is in consumer cyclicals. And then we have another 14% in consumer services. And those three really makes up the heaviest percentage of it, right? And technology alone makes up half. Think about that, right? So that's how big and massive it is. It's designed to focus on innovation and growth, similar to VUG, but QQQ has way more exposure to technology and growth. Top 10 holdings, we have Apple at 11%, Microsoft 10.5%, Amazon is around 5.5%, and so is Google. Nvidia is 4.3%, Meta is 4%, Broadcom is 3%, and so is Tesla, right? So Tesla is also 3% within this. And then lastly, we have Adobe at 2.2%. Yes, Adobe. You're thinking Photoshop, you're thinking, that Adobe. Yep, it is that powerful. Don't sleep on it. So that sums up the three main funds that you want to have in your Roth IRA. Remember, the first one is VOO, the second one is VUG, and then lastly we have QQQ, right? And these, you can buy these three funds alone and buy nothing else in your Roth IRA, and you are going to do better than 90 to 95% of the people when you reach retirement age. You can buy these same funds as well, not just for your Roth IRA. You can do the same for your 401k if you have them. If you have a taxable brokerage account, these are also great foundation pieces to really set the portfolio out strong when it comes to your taxable brokerage accounts, okay? Now, let's talk about the two dividend-based ETFs that I'm providing you, because some people also like having some dividends or an income producing type of fund in there where they can reinvest those dividends to help grow the portfolio. So we're gonna cover the remaining two, and let's get right to that. Vanguard High Yield Dividend ETF is by far my favorite dividend ETF of all time. It is made up of companies that have a strong historical performance of paying dividends consistently for decades. Not only that, but also increasing it on an annual basis, meaning every single year over the decades, right? And so you've put all of that into one basket to help you gain way more dividend income and dividend payouts that you can reinvest to scale your portfolio. VYM stands out because it pays investors a dividend yield of 3.2%. And this is huge, okay? Imagine even the money sitting in your savings doesn't even give you 1%, right? A lot of these high yield savings gives you maybe around 3, 4, maybe 5% give and take. Some of these bonds will do the same thing. But with these dividend, this high yield dividend ETF, you are getting 3.2% without lifting a finger. And all you do is you can actually automate those dividends that you get paid in to be reinvested. So just a quick analogy, quick example. If you invested in VYM and let's say you bought one share at $100 a share, that means at the end of the year you get $3, right? That's a $3.2, but let's just say $3. And so the more you can accumulate the amount of shares, the better. Not only does it pay strong high dividend, it also does have some capital appreciation. It just doesn't grow as much as say VOO, VUG, or QQQ. And like all ETFs, there's a similar theme here. You don't want to be exposed to just a few individual companies or just a few individual sectors alone to provide you this dividend yield, right? Because again, we can't predict the future and anything can happen. And so we're gonna look at the top 10 holdings within VYM. And so once you notice that, you'll be like, oh, maybe I don't even need to buy this individual stock. I have it already here, and I benefit from both some of the capital appreciation, maybe not as much as the other ETFs I've recommended earlier, but I also get a higher dividend payout by holding this fund, and I don't take on all the risk. The top 10 holdings make up 25% of VYM, and you will notice something particular is that the makeup and composition of this ETF is very much different from what we've covered already within our capital appreciation and growth ETFs, right? And so that's something to pay attention to. Certain companies and certain industries, because of the business model and the demand and how they operate, they tend to have higher levels of cash flow, and they tend to utilize that cash flow differently. And a lot of times they give a good amount of that back to investors. Because when companies pay you dividends, that's exactly what they're doing. They're paying you, they're giving you back some of the money that the company made from its profits. ExxonMobil holds the #1 spot in this top 10 list, and that accounts for 3.3%. JP Morgan and Chase is second with 3%, and Johnson & Johnson and JP Morgan are tied. So Johnson & Johnson also holds 3% in this top 10 list. Procter & Gamble holds 2.7%. Broadcom also holds 2.7%, and Home Depot holds 2.3%. The remaining 4 individual stocks hold 2% each in this top 10 holdings, and the remaining 4 companies are Merck, Chevron, AbbVie, and Walmart. It's interesting because for a high yield dividend fund that is not designed to actually really grow and is more focused on paying dividends, you still get the best of both worlds a bit. Aside from just the dividend payouts, it has provided investors with capital appreciation. So over the last 5 years, it has grown 30%. Over the last 10 years, it has grown 73%. And over the last 20 years, it has returned a total of 114% back to investors in capital appreciation. And then you add the dividends that is paying out to investors throughout that entire 20 years. So you can see you get the best of both worlds there for sure. Last ETF is Charles Schwab US Equity Dividend ETF, ticker symbol SCHD. If you recall, I mentioned that VYM has an annual dividend yield of 3.2%. This one right here, SCHD, has a dividend yield of 3.6%. And so to put these dividend yields in perspective, most or the average individual company kind of pays around 1 to 1.5%, right, in annual dividend yields. These funds are paying 3, and in some cases nearly 4 times as much. SCHD fund actually tracks 100 individual stocks and combines them all into a nice little ball that feeds us and gives us extra money within our investment journey. Similar to VYM, the advantage in having a diversified ETF as such is to diversify your risk and ensure that you're going to continue getting these income streams and dividend payouts. And so both of these both of these dividend ETFs, VYM and SCHD, both pay out dividends on a quarterly basis, meaning every 3 months. When it comes to SCHD, the top 10 holdings make up 40% of the entire fund, right? And so when you think about it, that is a huge percentage, and the other 60% is made up of a bunch of other individual companies that pay strong dividends and have a strong track record of long-term dividend payouts without skipping a beat. First on the top 10 is Verizon with 4.5, followed by Broadcom with 4.4, and then Amgen is coming in around 4.2. Coca-Cola, Pepsi, and Home Depot comes in at 4% each within this top 10 list. Coming in with 3.8% each are both AbbVie and Merck. And then the last two comes in at 3.6% each. And the funniest thing is, one of them is Texas Instrument. Yes, and many of you are familiar with it. That is the one that we grew up on using their calculators all the time. And so we thought they were a calculator company, right? Like the mid calculators. We have no idea. We were the furthest thing from the truth. You should see some of these things that this company works on. So just a simple Google search alone is gonna let you know just all the different things that this company work on, and they're very powerful and they're huge. They're not just a calculator company, okay? And then the last one is BlackRock, which also holds the same percentage as Texas Instrument. Despite its focus on dividend payouts, it has also returned investors with capital appreciation. So over the last 5 years, it has returned 48%. Over the last 10 years, it has returned 97%. And over the last 20 years, it has provided investors with a growth and profit of 184%. Again, two very powerful dividend ETFs, which is VYM and SCHD. When it comes to your Roth IRA and what to buy to get you to that financial freedom goal that you have set for yourself and your family down the road, these are all the 5 funds that you need. You can simply buy the first 3 that are focused on capital appreciation that I discussed earlier, which were VOO, VUG, and QQQ, and you're gonna do incredibly well over the long term. If you're somebody who also wants a little bit of exposure to some high-paying dividend ETFs, then as I've recommended and provided here in this video, you have VYM and SCHD. And in my opinion, these are the only 5 funds you really need to do well in your Roth IRA and invest in the stock market without destroying your retirement. Making sure that you're building your portfolios, especially retirement portfolios with index funds, ETFs. This is going to give you that sustainability, longevity, growth, reduce the downside of your risk, take advantage of the tax implications and benefits there, take the passive approach, diversify that risk, and you're going to do incredibly well over time. And always keep in mind that just creating the account is not enough. We have to then contribute money to it and use that money to buy some of these investment vehicles that I've highlighted in this video. I hope you found this video insightful and valuable to your financial journey. And don't hesitate to give us a thumbs up if you enjoyed it. Feel free to share with others so they can also benefit and build their financial freedom vehicle. And lastly, don't forget to subscribe if you haven't. If you have any comments, any questions, any specific ETFs that you would like to see me dive deeper into, or ETFs that you invest in when it comes to your Roth IRA and you want to share it with the public, make sure to drop it in the comments below. And make sure to remember that financial literacy, wealth building is a journey that we are all on together. So if there are any specific things that you would like to see me cover and elaborate on, make sure to communicate that. Additionally, I love feedback. Give me as much feedback as you can, because that's going to help me make better quality videos for your enjoyment and your learning. Until next time, stay informed, stay empowered, keep feeding the money printing machine, your Roth IRA, 401k, traditional IRA, taxable brokerage accounts, and I'll see you in the next video. Stay tycoon. Cheers.